Chris on the call, Chris Murray and Ben. And
Hey guys.
Hi, Chris. Thank you for joining.
Hi, Marty.
So, Chris, you are going to present Iron Bank or Aave?
Yeah, I'm going to present like a sort of compound strategy or composite strategy, which uses two protocols, which is slightly different to some of the other stuff we've seen before. But yeah.
Okay, cool. Yeah, that's nice. So I guess yeah, you have been the first one on the line and are ready to start your.
Sure. Yeah. So firstly, I just want to say, like, I'm sorry I haven't joined a few of the previous calls in the last few weeks. I've been in PST and 6 a.m. is a little bit early, but I have watched a lot of the recordings because I always find these sessions very useful and informative. And one thing I noticed with like a lot of the previous presentations while I share my screen, like a lot of everything I've seen so far has been around like specific, oh, wow, I'm going to have to restart Zoom. This is what happens when you get a new computer, then you have to update all your permissions.
Yeah.
Okay, hold on. Sorry, I'll be back in 1 second.
Join again. Yeah. Sharlyn, do you have present with what did he present last time?
Chris?
Which project? Yeah, Chris.
Meme.
Yeah.
Meme. That's interesting. Are you back?
Yeah, so the strategy I presented before, there are some similarities, but what I did was just kind of change the money market element of it. So you could still do MIM,
cool.
But MIM, as we've seen, I mean, I think if anything, the most recent drama has shown in some regards like the stability of MIM, I guess, because right, it's like it held its peg relatively well, and like Spell hasn't like gone to zero. But hey, so the strategy, what I'm going to present now is like it uses some similar ideas, but is maybe a bit more mature. And yeah, what I was saying before I had to reboot was that like a lot of the other techniques that we've seen presented are more around like integrating with one protocol. But I think that Aladdin DAO and like the broader space of where we can find sustainable yield often requires a bit more composability and taking advantage of spreads between rates in different places. So what I'm going to talk about basically is like a simple way of just taking advantage of the high rates on convex and the potentially lower rates on money markets for assets that can be pulled on convex. So pretty simple stuff, but I feel like there's a fair bit of advantages that you can get for doing this with like relatively low risk if managed correctly, especially on assets that maybe you wouldn't have been able to find yield in other places. So the basic premise of this strategy is simply to borrow where yields are low and to supply where the yields are higher. And I think the best way to think about this really is to just look at like a very common money market like Aave and as a venue for supplying ETH and borrowing stablecoins against that. The reason I like Aave as a venue for borrowing ETH is that its APY is actually like not zero like it is in a lot of other places, and their loan to value is much higher than most other places. So it's 85%, which gives you quite high capital efficiency. If you're feeling like using MIM, or conversely, there is actually liquidity in Abracadabra, then you can go up to 90% loan to value, which is the same as Liquidity and as Iron Bank. But yeah, your risk profiles are going to be marginally different with those money markets. So anyway, for this, the purpose of this example, let's assume we use Aave, because I think for a project that wants to like do this in any reasonable size, Aave is a good venue to do that. So basically what you're going to do is supply your ETH onto Aave. You'll earn a pretty insignificant 0.3% APY on that. And then you can borrow stable coins against that. So the question of what stable coin you borrow is going to be a function of what curve pool you want to go into, or convex pool. And for the purpose of this example, I'm just going to use the MIM3 curve pool, because I found this pool to be like consistently above 20% APY, or around 20% APY, and upwards of 30% over the like last 6 months. Like if you just track that pool, it's done like historically very well. But I think it's important to note that this technique doesn't have to use that pool, right? Any pool in which you could put stable coins, this would work. We'll talk about the risks of choosing a MIM pool a little bit later, but I think, like I said at the beginning, like we've seen MIM actually hold up pretty well despite a lot of the drama and shit that's happened. So basically you're going to borrow stable coins and then lock them into a curve pool. And the APYs that you can expect to that are going to all be a function of how much risk you take on in that debt position. I think that a fair expectation of of using a money market like Aave would be to try and borrow half the value of the ETH that you put into the money market. So if you deposit $1 million, you want to borrow $500,000 in stable coins. And you're going to pay on Aave 3.13% when I looked last night to borrow USDC. But you also get offset by Aave rewards of 1.54%. So it only really costs you 1.59% to borrow Aave, to borrow USDC on Aave. If we then factor in how much you earn on your ETH and like the size that you're borrowing, it's actually pretty cheap to borrow, like sub 1% kind of thing. So if we then put that USDC into a convex pool, which can earn us 20% yield, and seeing we're actually only using half of the capital we put into the money market, you now have a 10% APY approximately, right? A position in ETH. And if the rewards that you get from convex are swapped back to ETH frequently, then you have approximately a 10% APY, ETH denominated APY, which is better than you can get anywhere else by like double, right? Now, obviously, there are venues which you can get higher yield on ETH than this, but maybe taking on more risk. And there'll be venues that you can get a lower APY than this, taking on less risk. And fundamentally, it's a question of what risks do you want to take on. What I like about this strategy, though, is you're not taking on any direct price risk because the positions can always be unwound, right? So assuming you've gone in and like borrowed half of the value of what you deposited, you're based off of your loan to value, you're going to be using about like 60% of your loan to value. So you can tolerate approximately like a 40% market move before you get liquidated. That should be enough headroom to unwind your position. And you can do this using a smart contract as well, right? To unwind your position well in advance as the market starts moving. So what you can do is you can build a system where you have a target utilization of your loan to value. And as the market moves up and down, you either unwind your position in convex to de-risk, or you increase your leverage as the price goes up to keep that target utilization. And I drew like a simple diagram of kind of what this would look like, but this is fundamentally the same as what Yearn was doing like midway through last year. Instead of using a money market, they were using a CDP, and instead of using convex, they were using curve directly. The real difference is Aave or like one of these newer money markets has a much higher capital efficiency, and we can get like much higher yield. So yeah, you can get high ETH denominated yield doing this, which I think is really interesting. Assuming you can build that risk management module in a way that actually manages this risk well. And basically what you would be doing with that is like enabling any worker who can see like certain parameters on that contract being out of alignment of some target to call that. And you're going to simply unwind the position. Now, obviously, this assumes that there has been no deviation in any of the stable coins. And that leads me on to the risks. So I mean, we spoke a little bit about the liquidation risk, but yeah, the bigger risk, and this is really going to define the tolerance of which pool you choose, is like what risks you want to take on. So the pool that I described above, we're going to be taking on USDC, USDT, DAI, and MIM risk, which, that's dependent on your tolerance for risk. Might be too much. Maybe for the DAO it might be too much, in which case you choose a lower risk pool, right? I think that taking on those kinds of risks is probably okay. The issue though, obviously, like if MIM was to lose its peg, then the curve pool is going to end up holding a whole bunch of MIM, and we won't be able to get back sufficient USDC to repay the debt until such time that the MIM peg has been reestablished, or it goes to zero, in which case you lose all of your borrowed collateral. So that's, I think, is the biggest risk with a strategy like this, but I think it can be mitigated by choosing different curve pools. I mean, if we look at curve, there are other pools of lower risk which are still very high in yield. And obviously we're looking specifically in the stable department. So, this is based off of the current prices, but I think there are other pools here which could be selected, which have a more tolerable risk profile. And obviously there are other ways of approaching the same thing. Like you could use RAI and like create debt directly from RAI without borrowing via a money market. That's an option. And if we were to scroll up, these fixed forex pools I think are very interesting. And those are Iron Bank, which is what I was originally going to talk about. And effectively, you would use the same strategy where you borrow these exotic stable coins against Iron Bank and then put them into Curve. Same kind of risk profile, but the difference is really that Iron Bank is maybe less reputable than an Aave style money market. But yeah, I think that the basic premise of what I'm presenting is like a money market plus a convex rate arb can be done on it with any money market with sufficiently high loan to value, so you can achieve some level of capital efficiency and high yields on Curve. So yeah, that's basically the strategy. And like I said, like the risks are you get liquidated, so you need to manage that risk well and like design this risk module in a safe way that enables any data worker who monitors the system being out of whack to rebalance it using an oracle and a target utilization. You're taking on the stablecoin risk, and you're also taking on like a fair bit more protocol risk than some other strategies might. But the flip side of this really is like if we choose safe protocols that are very unlikely to be hacked, stuff that has billions of dollars in it, I think you could argue that the risk in a strategy like this, the risk of Aave getting hacked is probably much lower than one of the sort of newer protocols that we haven't really been battle tested quite as much. And Aave, Curve, and Convex have all been battle tested very heavily. So those really are the risks. The last thing I'll say on this, what's interesting about this idea is you don't have to just use ETH, right? You could use a money market that lets you deposit a whole bunch of other assets, which you can then borrow against. So on Aave, you can borrow against your Bell or your Wi-Fi or your Uni, which means that you can gain yield on things that maybe didn't have yield opportunities anywhere, right? Like, I don't know of a venue other than like LPing on Balancer where you can borrow against Bell and then actually seek relatively high yield.
I never quit on my shit. Jeff quit on my shit, but how much are we down or up?
Sorry, yeah, okay. I don't think you muted.
Sorry, brother. Sorry.
All good, you're good. Yeah, so, and then obviously also we can swap out the money markets. So we might want to use multiple money markets depending on different risk tolerances. But obviously starting with one in like this very simple flow would basically be the starting point that I would recommend for this kind of strategy. So that's basically what I wanted to present. Very, very, very simple strategy, but does use some level of composability to access I think yields in a slightly safer way than some other more degenerate stuff, but it is a bit more custom and would require a bit more smart contract work to actually create this risk management module to wind and unwind these positions.
Okay, yeah, thanks. So, but Meme, so the spell itself did something similar in a way. They just, it was like a money market too, but basically you would not recommend to use them anymore.
So if you were using Spell or Abracadabra, you would be minting them against ETH. The difference is in that context that they have limited liquidity. So firstly, that's the first point. Like right now, when I looked yesterday, you can't mint them. And you're also directly
they're full again,
taking, Yeah, they're full again, exactly. They're always full. So this kind of lets you work around that without having to directly interact with MIM. You're using a different money market. But I mean, yeah, fundamentally that would be the same thing where you would be minting in one place, taking the MIM, putting it somewhere else, and then managing the risk around that. But yeah, you can do that with any venue in which you can borrow a stable coin. But I think like if like the risk tolerance of MIM is not there, then you can use a different farm. And I think that's kind of the point of what I'm presenting here, is like it's just more of a general idea than like one particular strategy.
Yeah, I did that with the Iron Bank and the USD. Yeah, because I'm Switzerland, and this is the only Swiss franc out there is like was decent liquidity. Is the Iron Bank's Swiss franc was like a, and I used it for the same purpose as you presented.
Yeah, and those have like they had like 60% APY for like
yeah, it was quite
6
high.
months, and it used to even be higher. Like I did the strategy with the Iron Bank one personally for a long time. It was very, very good.
But then I hit the bug, you know, so it's like it's a strange story. Anyway, but you there's no other place, because what you think then what's the best way is to get some meme somewhere, because then if meme depegs, you have to pay back the cheap. You can buy it on the market for cheap and pay it back basically.
Maybe. But I mean, I think
there's no meme out there except from Abracadabra, I guess. You can't borrow it otherwise.
Yeah, you can borrow it in a few venues. You can borrow it at Iron Bank. They have a fair bit of meme liquidity.
Okay.
Yeah, I mean, I think that's really like a question of what kind of risks one wants to take on, you know. And I think like with this kind of strategy, you could potentially do it in multiple pools to take on different risks. But yeah, if you want to do the meme strategy, then maybe going directly for meme borrowing is better, perhaps. But yeah, because you're right. If it depegs, then you can pay back your meme debt for less, but and you also will have more meme to withdraw from the strategy. So it could help you in that scenario.
Yeah, it's the strange thing is that there's no product out there who's doing this for you basically, because it's yeah.
Yeah,
you know,
I mean,
I did it myself,
kind of like
so you propose it now, so it's a very it's one of the strategies to do basically, and Yarn is doing this partly, but not really.
Yeah, and I think also like as the money markets mature more, and like as we can access additional forms of deposited assets, like this kind of just broad idea and like building the tooling around this will be useful, right? So if you can deposit like staked ETH, right, and then you borrow like very conservatively against those staked ETH and gain like a little bit of additional yield, like just by taking advantage of some composability, you're going to be able to get better yield than you can get in other venues. Yeah, so I mean, like Yearn was doing this, right, with a CDP. Like this is not like a new idea, but they stopped doing it because like they felt the risks were too high. And I think a lot of that's due to the fact that they were doing it in like such a large size relative to the rest of the DAI ecosystem at that point. Like this was before Black Thursday type thing, before like they introduced USDC as a collateral in multi-collateral DAI. And also DAI requires 150% collateralization. So like your capital efficiency is like way lower than, you know, what it would be on like Aave. So I think like this kind of idea is going to always be around, and it's just like a question of like when is the market mature enough to support something like this. And obviously like as things grow, the yields and the opportunities and this will go down, right? Because like more institutional players will come in and do these kinds of things. But at least for now, I think it's a pretty good opportunity.
Yeah, go ahead.
Oh, sorry, Martin. Go. I like the thinking here. I think a few of the money Legos that I would think to use, and I'm kind of like I think repeating just some of what you covered here, but I'm fond of Aave. However, if we were going to like borrow stable coins against ETH, one of the tools that you pointed out I really like is DeFi Saver. And that's only because then we've got the ability to automate paybacks on ETH just in case, you know, just in case the market, you know, moves against us. But if while we're on that topic, as much as I love Aave, and full disclosure, I'm an Aave holder, so I probably always have a little bias towards Aave. I've been really impressed by Liquidity. I feel like they've just continued to grow and obviously become a more battle-tested protocol for borrowing at a very high loan-to-value ratio. And so I'd have to double check though. I don't think it's. I want to say it's like 90%, and
It's not 90
Aave.
on Liquidity, but their LUSD is not in any meaningful pool. So you would need to swap from LUSD to another stablecoin first.
Exactly, and so I'd have to double check, but if DeFi Saver offers the same sort of
So
the
the problem with
automation,
DeFi Saver is like when you unwind your position, what you're doing is you're pulling out collateral, selling it for debt,
correct?
paying back your debt, which is not what you want to do, right? What you want to do
Right.
is you want to pull out from the money from the yield farm from Curve or Convex, and then directly pay back the debt without having to sell your collateral. Because you like DeFi Saver, if you've gone like levered long on ETH, then you want to like you don't have any other option. But the beauty of this strategy is that your debt, you haven't sold your debt. It's just put in a different venue. So you want to take it out of Convex and then directly pay it back. So what this is basically building is your own variant DeFi Saver, right? Where like you're unwinding a position rather than like forming a trade to decrease your leverage.
Yeah. So I agree. We would ideally not want to be paying back debt by selling ETH with the automated like position in DeFi Saver. I think the reason I point that out is it is like, it's a stop loss. It's a safety net just in case of an absolutely catastrophic sort of like market condition. I mean, DeFi Saver has saved all the positions, or I think nearly all positions, even during the Black Thursday event. So that's the only other thing I wanted to point out is I definitely sleep better with a stop loss like that. But ideally, yes, we would we would want to set that at a collateralization ratio or LTV that it would only be there as like a again as a true stop loss or final effort to save our position if the market's got that ugly.
Yeah, I mean DeFi Saver, all it really is a bunch of scripts that have permission calls on like DS proxies.
Yes.
So we would be able to like construct one of these like you basically need a script to roll into the position and one to roll out, and then like permissioning on the DS proxy to actually enable that. So we could like probably use a fair bit of their existing infrastructure to build this, and then like you say, like have them as like an absolute backstop in the failure mode case. And I think the question really is like how much size is there going to be, right? Because like the reason Yearn abandoned this is because they had like, okay, well, what happens if we put $500 million into this thing? Like, what are the risks that this introduces and the systemic issues? So I mean, I think like the whole space has grown enough now that those systemic risks are perhaps smaller for that kind of volume. I don't think we're going to attract like a few $1 trillion or $1 billion. Like if our deposits like are starting to approach on the total size of Aave, then we have a problem. And then I don't think DeFi Saver can take that. Smaller size than that would probably.
Yeah. No, this is great to revisit. So much of this has continued to become more liquid and grow, and every day that all this infrastructure survives and doesn't succumb to some like doomsday exploit. I mean, we obviously get stronger and have more conviction to be able to use these tools. But yeah, I like a return to the basics that you're suggesting here, which is like we've got a solid store of value, we're borrowing stable coins, and we're maximizing that sort of yield with the stable coins versus like I think all the other sorts of like fleeting short-term sorts of farms that are out there. Like this is something that's not going to go away. Like you'd be able to do this in basically any market.
Yeah, exactly. And as soon as you like, and if let's say one of the strategies becomes less profitable or one of the venues becomes like there's a cheaper place to borrow, like you can take the same infrastructure that Aladdin would need to build for this and just change out the money market or the venue, right? Which is what I think is really cool about this is like it's exactly like you said, DeFi Dad. It's just like it's a strategy, it's a technique that can be part of like a broader set, and and like you said, it's not fleeting, right? Like there will always be yield arbitrage, right? Like that's literally what this is. It's just like a DeFi version of that. And I think like if anyone's looking for sustainable yield or a DAO is looking for that, it's a nice way to achieve that.
One follow-up to that, Chris, is I would, as you were like suggesting, like developing like our own tools and having to like code that up. I would, and this is maybe because I'm not a developer. Maybe that this is less work than what I'm estimating it to be, but just the fact that like we know Gnosis Safe works well. We know that like a tool like DeFi Saver or Instadap that allow for that sort of automation of a position exists. I would that would be something I would want everyone to sort of consider, because getting this strategy live would take, I'm guessing, that much less time, whereas like I worry about like sinking resources into developing tools, infrastructure, code, whatever, to enable all of this. So anyways, that's something I guess I'd ask others to weigh in on, like whether it, like what makes the most sense. I tend to think like, can we like, begin to test this out, see if there's an appetite, within the market, but like keep it simple and just manage it through like a Gnosis Safe and, using DeFi Saver.
Yeah, I think you can. What I would need to do, what I think you would need is like, you don't want to use DeFi Saver to sell ETH. So maybe you would use like the recipe creator on DeFi Saver to actually create one of these DS proxy interactions that the multi-sig could execute. Because like, as soon as you're selling ETH, like you're losing, right? Like that's not the point of this strat, especially when you're selling it on the dip, right? Like that's like the worst possible time to sell it. But yeah, I think you definitely could do this whole thing with a multi-sig. I mean, that basically amounts to anyone who's doing this at home, what they're doing, right? Like where they're actually doing that. So yeah, I think as like a path to quick access in the market, that would achieve that quite well.
So Chris, I have a question. So just take a step back to meme you talked about last time. And so can you just talk about briefly how their liquidity constraints actually is determined, right? And after the recent saga, where do you see that product will go?
Yeah, that's a good question. Honestly, I'm not like super involved in any of their governance or like more than just like superficially following along. But yeah, I think that the evolution of their liquidity has been quite haphazard, which is part of the reason why I've personally removed most of my stuff from their products, because it makes me a bit uncomfortable. Yeah, so I don't have like a good answer to that. I don't know where it's gonna go. I think we're like at the whims of some magic internet frogs at this point, which is part of the reason why I don't want to need to be involved so much anymore.
So
Yeah. Thank you. I don't know if there are more questions. The thing is, I forgot to mention that I have to leave earlier today, so Sharlyn will take over the moderation for the rest of the call. And
yeah, I think we'll go to Pan Zhixiong for growth.
Yeah, thanks, Shirley. I'll present my strategy for grow.xyz. Let me share the screen. Yeah, my strategy is pretty simple and straightforward. Most of the process is automatic. Yeah, I've invited the grow team to our research meeting to understand their mechanism. So my strategy is like we just put the stable coin to one of their Vault product. They're just called Vault. They have 6 to 7 APY right now. After we put the stable coin, the three kind of stable coin to the Vault, we can using the like LP token or C token to their Vault Vault Pool to farm their native token. So the strategy mostly is like investment strategy to invest in their Grow token. The Vault Pool right now is like 30 to 40% APY, and then you will need to waiting for 1 year to get all the token. It's like their vesting schedule is pretty different like others. You won't get the token immediately. You need to wait for 1 year. Yeah, so that's the simple strategy. Now let me share their website and how we go through their strategy. Yeah, you can see this is their website. They have two major products called Vault and the PWRD. The Vault product is leverage yield using PWRD's fund to integrate with some very big DeFi product. If we check with their detail, they have put the fund money to the R-wave compound, convex curve. All of them are from very big protocol. Yeah. And then we can deposit to our stable coin to the Vault product. And yeah, you can get 6.8 APY right now. Yeah. And after we get the recipient token, we can put to farming their native token Grow. It has 6 farming source right now, but for our strategy, I suggest we can using the Vault Pool farming. It's just single, not multiple or pair. We don't need to have other risks. We just put the Vault recipient tokens to this pool, and then you can farm the native Grow token. Right now, you can see it has protocol return is like 6.8, and the Grow rewards is 78. Yeah, 37. Yeah. Then after we put the money in the pools, we need to use the rewards tab to vesting our Grow token. It has 1 year to mature. You can get all the Grow after 365 days. Yeah, but you can get 10% on day 1. So if you want to get 10%, you can just get on day 1, but you will lose 90% of the Grow token. So if you want to get all of the token, you need to just wait for 1 year. Yeah, and then they have some product called Labs, but it's based on Homoran Avalanche, and the APYs and the risks are not. I don't think it's fit for our strategy. So I just skip the Labs product. Yeah. So basically, that's my strategy of the growth strategy. Yeah.
Where do the funds in the vault get deployed? Like it's a protocol controlled strategy then?
Yes, protocol controlled. Yeah, if you put the stable coin in the vault strategy, it will split to this kind of protocols like RB compound, idle, yearn, curve. Yeah.
Okay, and then the staking component is just to get the bonus Grow token.
Yeah.
Okay.
Yeah.
Do we have any further questions for Pam and Girl? Okay, since we have Hassan, should you give us an alpha dropping session?
I would long SLP if I were you guys. No, I don't have anything right now in terms of yield. I think Chris's strategy is really good. I wanted to ask Chris, like, I know we're not talking about this, but like, if the MIM risk is siloed, if all MIM risk is siloed, like to the specific pool, why are people concerned that it's going to sell off? Like, why are people concerned that MIM is going to break its peg if each pool that you can mint MIM from is siloed?
I mean, yeah, so it uses like a Kashi market, which is like Sushi Swap's money market under the hood for each siloed borrowing venue, right? So that's how they do the siloing. I guess like the reason that people would be worried about it is like if one of them was to break the peg, then there's like a venue to buy the asset under price and like potentially pay off debt in the other venues that are overpriced. But that's kind of like the whole point of siloing it, right? Like that you can like keep the asset across these different money markets at a fair price. And I think like, you know, after all the drama we've seen now, like MIM held its peg relatively well, and that's kind of that like thesis worked. Like if one of them breaks down. So I'm not like the general sentiment, I guess, is just around like uncertainty, right? Like people don't really know, but the core like idea is still sound, right? Like you got these isolated markets, and as long as those don't have like ridiculously high loan to values, which some of them arguably do. I mean, 90% on ETH is pretty crazy, but yeah, it's been fine given the like liquidity of MIM in secondary venues to actually buy in when you're doing liquidations and flash loans and all of that. So yeah, I mean, I think it's still relatively sound, but just my big issue with it, like I was saying earlier, is like the cadence in which new MIM is issued, and like the decisions around when that happens is like not very clear always. But yeah, maybe I just need to get deeper into the spell DAO and the ecosystem around Abracadabra to better appreciate the whims of our supreme frog overlords. But yeah.
No, I understand. Like, it's not really a DAO. I hear you. Okay.
Yeah, as I understand it, the debt positions are pretty much always going to be safe, considering how well audited the bento box contract is. It's just if you have naked exposure to the convex pool, then you could just be hung on the MIM without being able to swap it. Like even right now, I think the curve pool only has like 8% 3 curve or something. So it's like if you had a big book, then you just wouldn't be able to exit.
Yeah, exactly. And that detail there is like that specific thing is my biggest worry for like Aladdin DAO doing this, right? So maybe like picking a different pool that's more balanced is a good idea.
Yeah, like Alameda lost like 80 million swapping out of that MIM pool on when everything was crashing. So I understand that.
But you see, like they like don't pull out when it's doing that, right? Like wait until the peg recovers, and like they wouldn't lost so much.
Yeah, no, and honestly, the A factor in that pool is super high. So they must have been, to lose that much money, they must have been literally taking some unbalanced portion of the 3 curve back. But yeah, no, I understand. You're right.
Yeah, and like if they just waited, like they would have also gained all the swap fees from everyone doing exactly what they did.
Yeah.
Yeah. So that's like rule number 0 with Curve is like if the pool's out of whack and you don't think the stable coin is broken, like don't touch it. Like wait, like someone else can eat that spread.
Yeah. Right. I agree. And you could use UST Wormhole if you're more comfortable there. Obviously, Wormhole had its own issues, but no, it's a great strategy.
Yeah, yeah, you could use that as well.
Buy some SLP. That's the alpha. Thank you, Chris.
SLP is 61% up on the daily.
Look at it 4 days ago.
Why are people more bullish on SLP again these days?
This is a little bit of mean reversion, but also like, you know, they're going to slash emissions moving forward, and it's going to be more expensive to farm axes and all this stuff. But like, it was wherever sold anyway. But yeah, I mean, like mathematically, right now, nothing's happening. But as they reduce like 150 to 175 million SLP emissions per day, it makes farming harder, which makes axes future value worth more because they're earning, the SLP they're earning is worth more. And especially going forward when they're cutting these emissions for like player versus enemy and just leaving them for PvP, it just means that the axes that are in existence or will come into existence are capable of earning less SLP at a higher SLP price. So it's like a combination of like supply emissions cut, more burn mechanisms for SLP, and like V2 of the game coming like sometime in March.
Very
But I
cool.
think, yeah, right now it's just momentum and front running that emissions cut.
Okay, we still have 15 minutes to go. Do you have any gossips?
I'm curious, anyone else have any thoughts on like UST after the whole debacle we just discussed? Like, and full disclosure, I hold Luna. Like I felt like there was a spillover of fear from everything going on with the Wonderland Danny projects. But yeah, just curious if anyone has I don't know, I guess had any like time to really think on this now and feel like it was all overblown, or whether that there is a risk that we've actually talked about here before related to the UST peg, you know, as markets crash, and it's something I think we've tried to be very mindful of if we were to ever use a UST strategy. But that being said, I just continue to sort of acknowledge all of the, not just all the growth, but all the money that's now into UST and into Luna, and it's just, you know, it feels like we've moved far beyond the crash that happened back in like May 2021. That there's too many market makers working to protect that peg. There's even projects like White Whale that allow for arbitrage vaults to help protect the peg. But yeah, what are you guys thinking about the whole UST peg debacle? Overblown or still concerned?
I remember seeing like the amount of rewards available for anchor yield like dropped by half over like a 1 month period. But I haven't like really followed it since then. So if anyone has like more recent news, I'd love to hear it too.
That was one of the things I was following too, even though I you know, there was a lot of talk about Terraform Labs replenishing that. I'm curious, like, how much of those rewards are left now, or maybe I missed, like, was there a replenishing of rewards? By the way, if anyone's unfamiliar with that, there was like a, you know, a kind of like a countdown. There was like 30 days left of rewards to continue to pay out the anchor rate at around like 19.5 or 20% APY. and so yeah, there was like a fear of what would happen if, you know, if the rate remains at 20% and we run out of rewards and folks start to basically like withdraw all of their deposited B Luna, basically like they'd be burning UST and just creating all sorts of like systemic issues.
Yeah, the website says they have like 12 million left, which gives them about a week or two. And then I think there's a governance vote taking place to top up that reserve from one of the foundations.
Yep. I definitely buy into the idea that those rewards, while unsustainable, being paid out at the rate they were, which was almost like 2 million a day, it to me is kind of like a marketing budget, you know, and that's kind of how they framed it up. Like, this has been a very aggressive growth strategy to, you know, to grow a dependency, like a market for UST, and I think they've been very successful with it. But yeah, of course, I want to see the I want to see the mechanism work better, where, you know, the underlying proof of stake assets are actually, you know, earning enough yield to replenish the anchor. I think it's the anchor reserve is the right wording for it.
Yeah, it looks like I just checked the smart contract on Terra, and it looks like there's only like $11 million left of reserve. So, I mean, if this doesn't get replenished, we'll see what happens pretty soon.
Yeah, it's crazy because this was all anyone was talking about. There's just so many, you know, there's just so much that's happening in the space right now. But yeah, I'm for what it's worth, I'm optimistic based on like just all the money at hand there, and you know, knowing the way that you know, I don't know Doe personally. I just kind of know him from a distance. Obviously, I think he knows if they get any lower here, like they're going to have to replenish it. If anything, it's to continue to build confidence.
Yeah, they just replenished it with DeFi.
Oh, they did.
Yeah, they just put in, Martin just put it in the chat. They just topped it up, the yield reserve, by 450 million. Yeah, no, look, dude, I was telling everyone this, like, Luna's almost, I hate to use this word, but like Luna's like too big to fail, kind of, with all the VC backing.
Yeah, knock on wood. I know, right? That's what, yeah.
There's just too much money for them they pump too much money into the system to let it die. So like, I think everything you're saying is right with Anchor, that it's not sustainable, the rate's not sustainable. But like, they could fix it by demanding, like, you get a lower borrow rate if you hold Anchor, like, you know, all the stuff we talk about, like, if you can't get 20% unless you also hold Anchor, things like that. They could do a lot of things.
Oh, like I like that. That makes a lot of sense, that you have to hold Anchor. Like, why should you be able to just dip into that and have like that's why the degen box, is that what it's called? The degen box? I mean, that's part of the reason that supply started dwindling. You know, you have people winding up positions through Abra, and so now you no longer have the I want to say, like, the harmony of the original mechanism, which was like, hey, you got proof of stake assets, deposit them here. We're gonna like capture all of the rewards that you would have earned, which helps us to enable this anchor rate. So the next big thing that I think is coming in a matter of months is, I thought that they're adding Sol, you know, a liquid staking derivative of Sol, and they need to add more of these, because if those are just going to be very large markets of holders, and if those holders can reliably borrow against their staked exposure to, like, let's say Phantom or, Sol, anything that's got, again, a humongous market of token holders that depends on a proof of stake consensus. That to me is a way to create it like a long-term sustainable market. But right now, I think it's very clever. It's like let's grow our dominance and get all the headlines about UST. And now they're at a place where you said it. It's like kind of they're not too big to fail. Knock on wood. If anyone watches this, like, always be aware, like, these stable coins are prone to lots of problems. I mean, DAI has had lots of problems. So, but they get stronger, obviously, the longer they exist and the larger the market of folks who are dependent on it and money Legos that are building with it.
Agree.
Yeah, I read the article just now, and it said that they plan to have the reserves be able to sustain another 12 months of farming. But if it can sustain 12 months of farming, I'm sure there'll be way more capital coming in over the foreseeable future, which might shorten that runway. I just wonder how they're going to be able to make that yield sustainable moving forward without bailouts, essentially.
I like that idea of you having to hold anchor. I'm not sure how you would gate that, whether it would be you have to hold a certain, I know they don't want to gate and stall the growth of more UST. But yeah, I mean, part of the problem here is I think that what Abra created, I think there's more products like that are going to get created. And then at that point you have sort of you have a profit maxi or mercenary that's just depleting the anchor reserve without any sort of skin in the game to concern themselves that they're going to run anchor into the ground. So yeah, I like that idea of maybe having to hold some anchor, but then it feels like it wouldn't give you the result that you're looking for. It would actually create a reason for many to not be able to use anchor.
Yeah.
I think if anything, TLDR on all this, I just I don't have the answers to what we're supposed to do next, but I recognize that just a lot of the liquidity mining designs that I think we all originally were excited for, and we acknowledge it helped to grow an interest in this space. I mean, we went from 1 billion in February 2020, I think, to whatever it is, 250 billion today. Something here has to be improved. There's just it feels like there's a lot of spray and pray liquidity mining rewards. And then if you even think about just single token staking, which I feel like that's only grown in popularity, it seems to be it's a common design choice amongst most DeFi protocols. I feel, and this isn't my original thought, a good friend kind of framed it this way. They're it's a Band-Aid solution that's trying to solve for lots of high emission or high inflation tokens. It was what Curve has accomplished, because I'm fond of Curve's tokenomics. Let's also recognize that they had to course correct for a high inflation rate that was not received well by the market. And so there's a lot that's been done there to cleverly create better incentives. But if you had to start over from scratch as a DeFi protocol or any sort of Web3 protocol, you know, telling everyone like, hey, you just bought this token, or you whatever, you're a part of our community. Now you lock it up. It just, I don't know, it feels like a gimmick that is, it's not the most optimal way to continue forward. So again, I don't have the answers, but I've just been really sort of meditating on this, that like there's something really wrong here, and like we need new ideas. Actually, I think that's the key takeaway is I think that we like badly need new ideas to figure out a way to align like the incentives of token holders that helps to, you know, prevent dumping, but also of course serves like the utility of the protocol and you know, does everything to actually grow the use case of that protocol.
Makes sense. Makes sense.
Thank you, DeFi Dad. And thank you, Chris and Pam, for the presentation today. That's super helpful. And next week, we're going to have Brian Lee and Thomas Rush. And I'll keep you guys posted on next meeting. And thank you, everybody.
Sweet. Thanks so much.
Thanks, Charlie.
Thank you.
Thanks, guys.
Thanks,
Thanks, everyone.